Hashtag stop investing wrong in 2026, do this instead. The average beginner investor loses 37% of their starting capital within the first 18 months. Not because the market is rigged. Not because they picked bad stocks. Because nobody told them the 3 rules that actually matter. And right now, in 2026, with AI stocks going parabolic, interest rates doing things nobody predicted, and every finance influencer screaming a different opinion, the noise has never been louder. So before you put another dollar into anything, stop. Because what most beginners are doing this year isn't just wrong. It's quietly destroying wealth they haven't even built yet. Here's the real problem. Most beginners in 2026 are treating the stock market like a slot machine with better branding. They see a ticker trending on social media. They open their brokerage app. They buy. And then they refresh the app every 4 minutes until they either panic sell or get lucky once and think they're a genius. That cycle doesn't build wealth. It builds anxiety. A 2024 FINRA study found that 68% of self-directed retail investors underperform a simple S&P 500 index fund over any 5-year period. 68%. That means the majority of people doing what feels like smart investing, researching stocks, timing entries, following tips, are actually doing worse than just buying the whole market and walking away. So what's the move? Let's break down exactly what's working in 2026, point by point. Point 1, you're building on sand. Most beginners jump straight to picking stocks. But they skip the single most important step. Understanding what they actually own. When you buy a share of stock, you're buying a fractional ownership of a real business. Not a number on a screen. A business with revenue, expenses, debt, and leadership decisions. If you can't explain in 2 sentences what a company does and how it makes money, you have no business owning its stock. Warren Buffett calls this circle of competence. He's been saying it for 40 years. And beginners in 2026 are still ignoring it because understanding a business feels slower than watching a stock price move. This is where I'll be straight with you. One of the fastest ways to actually build this foundation is through books. The Intelligent Investor, One Up on Wall Street, The Little Book of Common Sense Investing. These 3 books will do more for your returns than any hot tip ever will. If you're not a reader, Audible is genuinely how I got through all 3. You can get your first title completely free, link is in the description. I'm not saying it to fill an ad slot. I'm saying it because audio was the only format that actually stuck for me personally. Build the foundation first. Everything else gets easier after that. Point 2, checking your portfolio is making you poorer. This sounds counterintuitive. But research from the University of California, Berkeley found that investors who traded most frequently earned 6.5% less annually than investors who traded the least. 6.5%. Compounded over 20 years. That's not a small gap, that's the difference between retiring comfortably and working an extra decade. The problem is that our brains are wired to do something when things feel uncertain. And a volatile market in 2026 feels uncertain constantly. Every time you check your portfolio and it's down, your brain registers it as a threat. You feel the urge to act. To sell, to rebalance, to do something. And that urge is costing you. The practical fix? Set a schedule. Check your portfolio once a month. Rebalance once a year. That's it. Put your phone down. Let compounding do the heavy lifting. It's not exciting. That's the point. Point 3, the account you use matters more than the stocks you pick. Most beginners spend hours researching which stock to buy. And 30 seconds choosing where to put it. That's completely backwards. If you're a beginner in 2026 and you're investing in a regular taxable brokerage account before you've maxed out a Roth IRA, you are leaving tens of thousands of dollars on the table. Legally. For free. A Roth IRA lets your investments grow completely tax-free. If you put $7,000 in this year, the 2026 contribution limit, and it grows to $70,000 over the next 25 years, you owe the government exactly $0 on that gain. Zero. Now, if you need a place to actually start investing, I'd point you toward Webull. They've built a genuinely clean interface for beginners. The research tools don't require a finance degree to understand, and right now they're offering free stocks just for signing up through the link in the description. Use it inside a Roth IRA if you qualify. That combination, the right account, a solid platform, and low-cost index funds, beats 90% of beginner strategies before you've even chosen a single stock. Point 4. The market timing trap. Right now, in 2026, there are 100 reasons to wait. Geopolitical uncertainty. AI valuation concerns. Election cycle noise. A friend who told you the crash is coming. Here's what the data actually says. JP Morgan ran an analysis going back to 2004. If you missed just the 10 best trading days in the S&P 500 over that entire period, your total return was cut in half. 10 days. Out of thousands. The best days almost always follow the worst days. Which means the people who panicked and sat on the sidelines missed the recovery entirely. Time in the market beats timing the market. Every study. Every decade. Every time. Start with what you have. Even $50 a month. The habit matters more than the amount right now. So let's bring this together. Stop picking stocks before you understand what you own. Stop checking your portfolio like it's a sports score. Start using the right account before you do anything else. And stop waiting for a perfect moment that will never come. The beginners winning in 2026 aren't the ones with the best stock picks. They're the ones who built simple systems and had the discipline to leave them alone. If you want to go deeper on this, and I mean genuinely understand the mechanics behind why index investing works, what expense ratios are silently stealing from you, and how to build a portfolio that doesn't require you to think about it every day, hit subscribe. Because the next video covers something that almost nobody talks about in beginner investing content. The hidden fee structure inside popular ETFs that can cost you more than $40,000 over a 30-year career, and the 3-letter ticker swap that fixes it instantly. That one's going to hurt a little. But you'll be glad you watched it.